Hello friends, my name is Ashok Sengupta from School of Management Sciences, Lucknow. Today the topic of discussion is dividend model part 6, and here we continue the previous discussion about the various model of the dividend and their usage. This topic belongs to financial management and corporate finance, a subject of MBA program in second semester. So, today our discussion is on dividend discount model. In financial model, that values of the shares at the discount value of the future dividend payment. Under this model, the price of the share will be traded is calculated by PV, present value of all expected coming future dividends, continued by the risk adjustment. The dividend discussion model dividend discount model price is the instant value of stocks. So, first we must understand PV, present value. Present value is a value which denotes what will the cost of or price of any payment if we receive in future with discounting. It is a part of time value method, where we use discounting because each and every time value of the money decreases. Value of the money decreases with time, and it is because of inflation, basically inflation. So, it is also to understand when a company paid the dividend, to a shareholder, at that time what will be its value? Here we must understand that present value equals to 1 divided by r and power n. R is the value, R is the internal rate of return, R is the expected value, n is number of years. If a person receive 1 rupee and expected return is 0.1 and period is 1, the value of 1 rupee become 9.09 after a period of 1 year. So, if a person get a dividend each and every year, what will be its actual receiving? After considering the inflation rate. Therefore, dividend discount model is based on a stock intrinsic value, where dividend amount which we received is discounted by a percentage, and we calculate the final amount. In this formula, see in this formula, D1 is a dividend of first year, D2 is a dividend of second year, D3 is a dividend at n years. After n number of years, like 10 years, 5 years, 6 years, any year, after a certain number of period, if the person sell its shares, sell its stocks, then we also need to calculate the value of the share by redeem value divided by the expected return. dividend divided by the expected return. So, the formula is sum of present value of dividend plus present value of stock sale price. If you sell the stock, after 10 years, so what will be its value? So, we need to calculate the intrinsic value of the stock by discounting the dividend over the period plus stock period plus stock value, because stock valuation is important part and time adjustment also need to be considered. If in the above equation it is assumed that the dividend is paid at the end of the period, it is also important. Dividend is paid at the end of the period, stock sold at the end of the year. At the end of the year, because this we consider this end of the year or beginning of the year because let us see 1st January and 31st December, this is the whole year. And if stock sold at the end of the year in this period, then we considered the interest, the KE, the cost of capital for whole year. Otherwise, if the dividend is paid in the first initial of the year, starting of the year, like in January, then we only considered the period before January, like previous year. This is January 2021, we can consider 2022, 2019 etc. So, it is important when the dividend is going to paid, it is the end of the year or beginning of the year. Our calculation is based on that. There are 3 basic classification of dividend discount model. First is 0 growth, second is constant growth and third is variable growth. So, first let us understand what is 0 growth. 0 growth rate assumes all dividend paid by stock remains same, all dividend paid by stock remain, so there is no growth. Here, like company is going to pay 10 rupee dividend per share and next year company paid 11 rupees, then 11.25, this is known as growth. So, when there is no growth, equal amount of dividend is paying each and every year, then 0 growth rate assumption is calculated, 0 growth rate formula is calculated. So, stock intrinsic value, price intrinsic value is annual dividend divided by required rate of return, annual dividend divided by required rate of return. So, annual dividend here required rate of return KE, you can also known as cost of equity. So, cost of equity and D, only 2 things are considerable. Take the example, it is better to understand any kind of theory with the help of numericals. So, here I just suggest a numerical to understand the topic. X Limited is a no growth company, payment of dividend is 5 rupees per share. If the cost of capital is 10%, so compute the market value of the share. So, this is simple question where a company has paying a dividend of rupees 5 per share and there is no growth. So, simply we just put the formula here. Our formula is D divided by KE, D equals to D is 5 divided by KE 10% or 5 divided by 0.1, if and we find here the value of the share is 50 rupees, value of the share is 50 rupees or rupees 50. So, this is the way we can find out the market value of share, when dividend is 0, there is 0 growth, no growth. Okay. Now, second important factor, second important classification is constant growth rate. Constant growth rate, like 5% growth, 10% growth each and every year, company provide constant growth to the stockholder every time. And here we can use the formula, d 1 plus g, d 1 plus g divided by k e minus g. So, here P is market price, D is initial price of dividend paid, okay, before growth, G growth, G is growth, and K E is cost of equity. K E is cost of equity. Now, because the constant growth rate is based on Gordon model, G is considered to be B into R. B is retained earning and R is investment rate. B is retained earning ratio and R is investment, or R is, you can say, rate of return from the investment. K E is cost of equity capital, G is growth rate of the dividend, where G equal to B into R, and D is current rate of dividend or current year dividend. XYZ is a company having share capital of 10 lakhs of 10 rupees each. It distributed current dividend of 20% per annum. Annual growth rate expect to be 2%, expected rate of return 15%. So, amount company having a 10 lakh capital, company's capital is 10 lakh, company's capital is 10 lakh here of rupees 10 each. It distribute current dividend of 20% per annum. So, what is the amount of dividend? So, our formula is D naught plus 1 plus G, I again repeating here, D naught 1 plus G, close the bracket, K minus G. Now, the D equals to 10 into 20%, 10 into 20%. So, value of D is 2, value of D is rupees 2, 10 into 20% 2. G, clearly defined growth rate is 2%, growth rate is 2%. So, just put the formula here, 2 into 1 plus 0.02, because 2% equals to 0.02 divided by Ke, divided by Ke. Ke is 15%, Ke is 15%, 15% equals to 1.5. So, sorry 1.15, 0.15 minus 0.15 minus 0.02. Now, 2 multiplied by 1.02 divided by 1 per 3. When we calculate it, the answer will be 15.69, the answer will be 50.69. So, here we find out that the amount of P, like present value, amount of price value of the share, price value of the share is depend on G also, depend on G also, and G is growth, and G is growth of the growth rate of the share, and it is constant, it is constant growth rate. When the constant growth rate, then formula we apply here, where we need to find out the value of D. In some question there is directly given the value of D, otherwise you have to you need to calculate the value of the D. Now, third approach or third classification is variable rate model or multiple stage growth model, can take many forms, even assuming the growth rate is different from every year. However, the most common form is one of that assume 3 different rate of the growth: initial, high rate of the growth, transaction to slow rate of the growth, and at last sustainable, steady rate of the growth. Basically, the constant growth rate model is extended with 3 phases, with each phase of growth calculation using the constant growth rate model, and then we moving for 3 phases. So, 3 phases of constant growth rate is multiple variable growth rate, where initially we have a high rate, then transaction is little bit slow rate, then we have a sustainable growth rate. So, it can be possible that if we graphically represent that one, initially growth rate is this, then this, and then it is steady. So, this period is transaction period, and where is second phase, this is third phase, and this is first phase. So, need to calculate the growth of dividend in every period. We can also calculate by to find out every year, it is quite long. If you need to find out the value of market price of a particular share in last 10 years, then we need to calculate the growth rate of dividend given by the company in the last 10 years and every year. So, because it is variable, the growth rate can be changed each and every year. In any year we can find that there is a negative growth or 0 growth or high growth, then we need to calculate the value of the price every year. Sometimes even the capitalization rate or the required rate of return may be varies if changes as expected projected. Because future is uncertain, in practice our cost of capital also varies, our expected rate of return also varies. So, we can vary the different forms of growth rate each and every year. Let us do a question. A firm has been paid dividend of rupees 2 per share last year. Estimated growth of the dividend from the company is expected to 5% per annum. So, expected growth is annually 5% per annum. Determine the estimated market price of the share at rising at 8%, as previous slides see here. Initially it high, rising at 8% and fall to 3% and all calculation on the basis of required rate of return is 15%, that is our cost of capital. Our cost of capital is constant and it is 15%. So, our formula is remain same, D naught equals to 1 plus G K E minus G. D naught already given 2 rupees, G, and now here G in first part equal to 8%, that is 0.08. So, here in calculation of first stage we need to find out and put the value of G is 0.08, K E given 15%, if 15% then its value is 0.15, K E is 0.15, value is 0.15. And final value after calculation all this thing 2 multiply by 1.08 0.15 minus 0.08 0.07, our value is 30.86, our value is 30.86. So, here the 30.86 value, is the market price of this share when G growth rate of dividend is 8%. Now, comes to when growth rate come down to 3, when growth rate comes down to 3%, the formula is remain same, we just replace the value of 8% to 3% and our calculation is 17.17. Our calculation is 17.17. So, when it is quite clear that when we provide the 8% growth rate, then this is the market price of the share, and when we are going to provide 3%, then market price of the share decreases, also decreases. So, hence it is quite clear that dividend payment or growth of the dividend having a huge impact on the market price of the share. So, at last I conclude the whole topic here. First, today we discussed about the dividend discount model. Because dividend discount model said what will be the actual value of the dividend received by a shareholder after certain period of time, because with the decrease with the time framework or inflation rate, the cost of capital or you say due to the inflation value of the money decreases. So, if we are going to pay 15 rupees or 15% dividend at the end of the period and end of the year, what will be the actual value of debt payment? We pay 15%, okay, nothing, we pay our liabilities because dividend have to pay, need to pay a dividend, but what about the shareholders? Either they are getting the actual value, because with the decrease, with the increase of the time, with the time framework, money decreases. So, they are getting a little bit lesser value because of the inflation rate. So, we discount the dividend amount, year wise, and finally, if an individual, if a company sell out their stocks, then we need to calculate the discounting value of debt stock as per the PV ratio. So, hopefully you understand this video, and there are three basic factors: constant, variable and growth, and hope you get available to understand what is the dividend discount model. Thank you for watching this video.